When you think about the Federal Reserve, you usually think slow, deliberate. But back in late 2025, whoa, they pulled a pivot so fast it could give you whiplash. So what on earth changed inside the Fed in just a few short weeks? Let's get into it.
Okay, so here's the puzzle, right? We've got two Fed meetings, October and December. And at both of them, they cut interest rates. Now, back-to-back cuts, that's not totally crazy, but the story they told about why they were cutting, that seemed to change completely. So what happened? What was going on behind those closed doors?
If you just look at the headlines, it seems pretty straightforward. A quarter-point cut in October, boom, another quarter-point cut in December. That brought the target range down to 3.5 to 3.75%. But, and this is the key, that headline number, it doesn't even begin to tell the real story. To figure this out, we've got to look under the hood, and we'll start with the Fed's own words.
All right, first up, the official statements. These press releases are crafted with extreme care. Every single word is scrutinized, and even the tiniest little change can signal a huge shift in their thinking.
Okay, so look at this. It's almost identical, right? In October, they said, job gains have slowed, unemployment has edged up. In December, job gains have slowed, unemployment has edged up. It's like they hit copy-paste. So their big picture view of the economy hadn't really fallen off a cliff. So if the job market wasn't suddenly collapsing, what in the world was pushing them to cut rates again?
Yeah, to really crack this case, we have to dig into the numbers the Fed themselves were looking at, their own economic forecasts. And believe me, this is where the story takes its first really big twist.
And the October minutes, they give us this huge clue. The Fed participants basically admitted they were in a particularly challenging environment. They were wrestling with this big question. Was the weakness they were seeing in the job numbers just a temporary slump, a cyclical thing? Or was it something bigger, something structural, maybe something driven by AI and automation? You can almost feel the uncertainty in their words, and that was clearly weighing on their minds.
And here is the kicker. You'd think, okay, 2 rate cuts. They must be getting super worried about the economy, right? Well, you'd be wrong. Get this. Their own projections for GDP growth actually went up. Look at 2026. They bumped up their growth forecast by a whole 0.5 percentage point. So they were actually getting more optimistic about the economy. How weird is that?
Okay, so what about jobs? That's the other half of their big mandate. Well, if you look at their unemployment forecast, it's basically flat. They thought it would hover around 4.5%, with maybe a tiny improvement way out in 2027. So no 5-alarm fire there. Their outlook for the labor market was pretty darn stable.
And then there's inflation, right? Their other big job. And guess what? The news there was getting better too. The December numbers showed inflation cooling off a little faster than they thought it would. So let's just recap because this is wild. The Fed is getting more optimistic on growth. Their jobs forecast is stable, and their inflation forecast is improving. So why on earth were they cutting interest rates? Well, the whole answer seems to boil down to this one little phrase from their statements. Downside risks to employment rose in recent months. See, it wasn't about the data they had in their hands. It was all about the risks they saw on the horizon. They were worried that this little slowdown in hiring could suddenly snowball into a big spike in unemployment. It was a preemptive strike. They were basically buying insurance against a recession. But hold on, because the rate cuts? That was only half the story. There was another, even bigger change happening, something that doesn't get as much attention. And it has to do with the Fed's giant portfolio of bonds, what we call its balance sheet.
Okay, quick refresher here. For a while, the Fed had been doing something called balance sheet runoff. It's simple, really. When their bonds matured, they just let the money vanish instead of buying new bonds. This basically sucks money out of the financial system, and it's a way of tightening things up, just like hiking interest rates.
So back in October, the Fed was basically saying, okay, we're almost done with this. The financial markets were starting to get a little creaky, which was a sign that cash was getting tight. So they made a plan. We're going to officially stop the runoff on December 1st, and that was a big deal. But it was still just taking their foot off the brake.
But then came December, and they didn't just stop the runoff. They did a complete 180. They announced they were going to start actively buying Treasury bills again. This wasn't just taking a foot off the brake anymore. This was slamming a foot on the gas.
And this comparison just says it all. In October, the plan was to stop shrinking the balance sheet. Just 2 months later, in December, the plan was to start growing it again. That is a massive policy reversal. They went from tightening to easing on this front in the blink of an eye.
So we've got late cuts because they're worried about future job losses, and we have this massive U-turn on the balance sheet.
So what does all this mean for where things are headed? To figure that out, we have to look at the one chart that every single person in finance obsesses over, the dot plot.
If you're not familiar, the dot plot is basically an anonymous poll of all the top Fed officials. Each dot on the chart is one person's best guess for where interest rates should be in the next few years. Now, it's not a pinky promise or anything, but it is the absolute best peek we get into what they're all thinking.
So when the December dot plot dropped, the first thing everyone did was look at the median. You know, the dot right in the middle. And compared to September, it didn't move at all. And this just sent everyone scrambling, right? If the median forecast didn't change, did anything really change at all?
But here's the secret. The real story wasn't the median dot. It was the spread of all the dots. The whole range of opinions got a lot tighter. See, back in September, you had some real hardliners, some hawks, who thought rates could be as high as 4.4% in 2025. By December, the highest dot in the chart had dropped all the way to 3.9%. The hawks were backing down. And that tells you the whole group's thinking was shifting towards lower rates.
And you know, this shift wasn't exactly unanimous. In fact, the number of people who officially dissented from the decision actually went up from 2 to 3 between the meetings. You still had one person who wanted a bigger cut, but now you had 2 people who wanted no change at all. So even as the consensus was shifting lower, the debate inside the Fed was clearly heating up.
Okay, so let's put a bow on this. The mystery of the Fed's big pivot, it wasn't because the economy was suddenly falling apart. Actually, they were feeling better about growth and inflation. The whole thing comes down to their focus on risk. They got really worried about what could happen to the job market, and they decided to act now to prevent it later. That's what drove the rate cuts and the big balance sheet reversal.
And that leaves us with this huge question, doesn't it? I mean, think about it. Cutting rates while you're upgrading your forecast for economic growth, that's not something you see every day. So is the Fed just masterfully pulling off the perfect soft landing, using their wisdom to steer us clear of a recession? Or are they seeing something scary under the surface that the rest of us are missing? I guess we're all about to find out.